Flagship real estate encompasses architectural masterpieces and ultra-luxury megamansions. These are properties built to function as legacy investments and status symbols. They form the high-profile portfolios regularly highlighted by elite real estate media and top-tier brokers. The initial acquisition is treated with rigorous financial scrutiny. Owners traditionally position these $20 million properties as static vanity pieces, generating a completely flat financial yield. Entering the short-term rental market shatters that flat line. Positioning the property as a luxury rental introduces multi-five-figure daily yields and elevated micro-seasons. But extracting those specific daily yields introduces a severe operational trap. Attempting to manage a complex estate using standard hospitality methods inevitably destroys the capital you are trying to maximize. Capturing peak yield without creating operational friction requires abandoning commodity hosting. The alternative is institutional asset governance. Accepting zero or negative cash flow on a multi-million-dollar property is a failure of technical architecture. It is not a mandatory feature of luxury ownership. To understand why standard methods fail, we have to look at the baseline environment. These properties rely on complex, interconnected commercial-grade systems, often heavily exposed to harsh environmental factors like coastal humidity and salt. Commodity hosting applies budget motel logistics to a high-net-worth estate. It relies on reactive human labor and basic scheduling to manage commercial complexity. This isometric cross-section maps out physical entropy. Constant guest turnover creates a quantifiable 3 to 5% annual degradation in asset value, heavily concentrated in 5 zones: kitchen appliances, HVAC units, plumbing, soft furnishings, and flooring. This creates tactile ambiguity. A $400 state-of-the-art smart lock fails completely when coastal humidity causes a heavy wooden door frame to expand by exactly 1 millimeter. The property management app shows a perfect digital illusion, confirming the door is unlocked. The analog reality is a VIP guest locked out in the pouring rain at 11 p.m. These micro-failures bypass standard management software entirely. The system reports all green, while the physical reality triggers a cascading chain of midnight crises. Unmanaged physical entropy drains net operating income. An investment originally engineered to provide financial freedom becomes a high-liability 24/7 job. The first layer of the asset governance stack addresses this mechanical decay. We replace reactive human repairs with computerized maintenance management systems. This involves deploying a network of Internet of Things sensors across the property's commercial-grade systems, measuring environmental shifts, vibration, and thermal output in real time. This data chart tracks the physical trajectory of an HVAC blower bearing. The system is actively hunting for microscopic anomalies, like this half-degree temperature creep, rather than waiting for the equipment to seize. Once the anomaly is flagged, the protocol triggers an automated timeline. A $50 part replacement is scheduled and executed within a narrow 4-hour vacancy window between guest stays. The alternative to this automated micro-repair is a catastrophic midsummer blower failure, resulting in an emergency vendor call-out and a $10,000 refund to an angry guest. When physical intervention is required, the execution is handled by pre-vetted, NDA-bound vendors, ensuring absolute discretion and privacy for high-profile occupants. Protecting the capital envelope demands continuous data streams. Hardware preservation fails when it relies solely on periodic human observation. Beyond the mechanical hardware, the human bottleneck presents the next operational risk. Ultra-luxury assets generate a staggering volume of highly specific, demanding guest inquiries. Short-term rental algorithms ruthlessly track and penalize slow human response times. A delayed reply pushes a premium listing into the algorithmic shadowlands of page 10 search results, cutting off discovery. Layer 2 implements direct API integrations of AI agents. These systems are trained specifically on the property's 3D digital twin and exhaustive operations manual. This removes the human variable. Routine friction points regarding pool heaters or media rooms are accurately resolved in over 90 languages in under 60 seconds. This revenue chart isolates the yield gap. Relying solely on the base nightly rate leaves a massive block of capital uncaptured on every booking. Layer 3 closes this gap through automated, app-driven concierge integrations. Affluent travelers actively seek out and pay for logistical convenience. By embedding direct options for private chefs, bespoke in-home spa curations, and secure premium pet governance, the empty block fills with high-margin returns. These specialized upsells generate secondary revenue streams without requiring a single hour of logistical labor or scheduling from the property owner. Automating both frontline communication and bespoke upselling converts a standalone house into a decentralized resort. The owner is completely insulated from operational fatigue. The final layer targets revenue generation. Native platform smart pricing tools operate with a structural conflict of interest. The platform algorithm optimizes purely for its own transaction volume. It will aggressively drop your nightly rate to guarantee occupancy, prioritizing a booked calendar over your net margin. This reactive discounting attracts bargain-hunting guests. In the luxury tier, these bookings carry high operational risk, accelerating physical entropy and rapidly eroding the property's brand equity. Layer 4 bypasses native tools entirely. This line graph shows an external API integration intercepting the downward pricing curve, enforcing a strict, unyielding dynamic rate floor. With the floor secured, the system scans localized data to identify hyper-local microseasons, short spikes in demand driven by niche regional events. Consider a set-in 3-day biotech conference announced nearby. This event brings a wave of price-insensitive executives actively looking for premium group accommodations. The system detects the data signal and spikes rates aggressively for those specific dates. It optimizes strictly for total revenue, ignoring the pressure to hit 100% monthly occupancy. By utilizing multi-channel analytics and strict rate floors, data-driven yield management regularly boosts annual net operating income by up to 40%. Strategic vacancy protects the physical real estate. Holding firm on an unyielding pricing curve produces a higher total yield with significantly less wear and tear than a high occupancy discount model. When you evaluate the sprawling physical footprint and interconnected systems of these estates, the necessity of rigorous optimization becomes obvious. True luxury in real estate investment is not defined by architectural finishes, infinity pools, or imported marble. The actual standard of luxury is rational certainty. It is the absolute invisibility of the complex technical and human systems working in the background to maintain perfection. Deploying predictive maintenance, AI communications, concierge integration, and algorithmic yield management eliminates the ownership paradox. The property works constantly, while you remain entirely undisturbed. Combining a flagship physical asset with a rigorous digital governance architecture creates the only mathematical path to peak net operating income. Institutional investors do not tolerate treating a multi-million-dollar estate as a chaotic second job or a static liability. To survive in the elite tier of modern hospitality, you must upgrade your operational architecture. Stop hosting and begin governing your property as a high-performance financial instrument.